Hello, everybody. This is Mike Hanghold. We are getting set for the first call of the new year. First, I'd like to welcome everybody. Thanks for joining us today. I'm joined by Doug Johnson. As you all know, Doug is a partner here with the firm, and he chairs our investment committee. Just two or three brief administrative announcements, and then we'll get on with the show. First, if you have any questions during the presentation, if you go to the bottom of the screen and hover, you should see a Q&A button pop up. You can submit questions through that. Second, if you would like a copy of the slides, let us know and we'll be happy to get those out to you. And finally, a replay of the webinar will be available on our website by midday tomorrow. And that does it. So let's get started. Within the last year, a little less than a year actually, we've had three pretty significant pieces of legislation that affect retirement planning, taxes, financial planning. We had the Secure Act at the beginning of last year. Then when COVID broke out, the CARES Act was passed with a lot of stimulus and various benefits for people. And just recently, in December, the COVID Tax Relief Act was passed. That has a number of benefits in it for individuals, and that's what I want to touch on tonight. But I also wanted to mention that there are likely two other stimulus programs that will be coming. So that will make a total of 5 that we think we know about. The next will be announced tonight. So President-elect Biden is making a speech tonight at 7:15, and it's expected there he will talk about the next wave of stimulus and some of his ideas to keep the economy on track and keep it from slipping back into recession while we go through the vaccine rollout procedures. The speech he's going to make tonight is supposed to be very nonpartisan. The idea is that the first bill that they pass, they want it to be very easy for Republicans to get behind. So it's likely, from what I've read, there was a lot of talk about $2,000 checks. That's likely not going to be the case. They'll be splitting the difference and so forth. But again, that's what the fifth bill will be for. That will be a bill that will come with more of the Democratic ideas that President-elect Biden campaigned on. So what I would like to do, though, is touch on a handful of the most relevant tax and financial planning ideas or concepts that came out of the most recent COVID Tax Relief Act. So the first one, and the one that people are waiting for, if you haven't seen your check already, is that more likely than not, there is a $600 either deposit that's going into your bank account or a check that's going into your, that should be arriving in the mail. And so the $600 is for individuals. Married couples will get $600 per person, so a total of $1,200, and you'll get an extra $600 for qualifying children. Those are kids under the age of 17, so it's not unlike the last relief provision that happened earlier in 2020, and that also means that it comes with phase-outs. So individuals with incomes of $75,000 or more start to phase out. I think it's $112,000 or $112,500 for heads of household and $150,000 for couples. So if your income goes over those thresholds, you will either get a reduced amount or potentially none whatsoever. Again, it's managed a lot like the program was at the earlier last year. Here's the wrinkle, though. It may be a little more complicated. The cutoff for sending out checks from the service is tomorrow. So if you haven't received your check yet or haven't seen your deposit and you don't get it in the next few days, the odds are that you're still in good shape. You're still going to get it. But what that means is you're going to have to claim it through your tax return. So this is really, in effect, a credit on your 2020 tax, as it always has been. And what you would need to do, do then is claim the credit when you file your tax return. And of course, there are administrative snafus. This all happened so quickly, and at the last minute, they realized that the criteria for qualifying was your 2019 tax return, and the process for filing and reporting was right upon us. So that's why the quick cutoff. After the stimulus payments, unemployment benefits. So this is something that is being reinvigorated. So those who have exhausted their regular benefits will be entitled to an extra $300 per week, and that will run for an 11-week period. So that'll exhaust itself about the middle of March. I think the beginning date was right after Christmas. So an extra $300 a week for the next 2.5 months or so. The next item, flexible spending accounts. These, if you participate in these, you know these as sort of the use it or lose it accounts. So you put money in, and if you don't get it all spent, then you effectively lose those dollars that you were not able to spend on qualified expenses. What the bill last year did, and what this bill extends, is the ability to carry those expenses over to another year, so you don't have to worry about losing them. Why would they do this? Well, obviously to make life a little bit simpler, but one of the big benefits that people pay for are childcare. And if somebody set money aside for childcare and then the kids didn't go because of being quarantined, that money could be lost. So it gives people the ability to carry these expenses forward, carry this money forward to use on expenses in a future year without losing them. On your individual return, charitable contributions last year, so in the CARES Act, we got an above the line, which means you don't have to itemize to take it, charitable contribution deduction. And so people were allowed to deduct, or will be allowed to deduct on their 2020 tax returns, $300 of charitable contributions, even if you don't itemize. That benefit has been extended, and if you are a couple filing a joint return, then that amount becomes $600. The limit becomes $600. For 2021. So that is a change. A lot of people thought, because the way a lot of these rules work, there's one limit for a single filer, another limit for a head of household, another limit for joint, something like that. That's not the way this worked. In 2020, it's $300 for everybody. And then in 2021, that jumps to $600. Now, the proviso here is the service has made it crystal clear that they intend to police this hard. They're concerned that since all people have to do is write the number 300 in the block on their tax return, that they'll be easily claiming a $300 deduction, whether they're entitled or not. So expect the IRS computers to be sending out confirmation letters. The moral of the story is keep your receipts for this. It's an easy thing to qualify for, but they are gonna chase it hard. Educator expenses. So teachers are allowed to take an expense, a deductible expense, for certain costs when they're setting up their classroom if they're not reimbursed by their school. What this law does is it clarifies that personal protective equipment, or the PPEs that a teacher might buy, also qualifies for that. The definition of earned income has been shouldn't say the definition of, earned income has been given a carryback or a look back period for those who are trying to qualify for the earned income credit, or the child tax credit, actually. And what happens, the earned income credit is actually what's referred to as a refundable credit, which means you can get a refund on your tax return even if you didn't pay any tax. But in order to qualify for these credits, you need to have some earned income. And the concern here was that someone might have been put out of work because of COVID. And so they might have had qualifying income in 2019. What this provision allows is to look back and use whichever is better, your 2019 income or your 2020 income, in order to qualify for these credits. This last piece is sort of a inside baseball, but should it apply to you, it's important to know. Money purchase plans are traditional pension plans. So most people these days have 401k plans, things of that nature. And these rules were already applicable there. But in the CARES Act, the provision was made to allow taxpayers to borrow up to $100,000 from these plans penalty-free. So most people know that if you take money out of your retirement plans too early, you have to pay a 10% penalty and it's taxable. This provision allowed people to take $100,000 out if you have a COVID-related expense, and that's the important part. But let's assume for the sake of discussion that you do. You were allowed to take that money without penalty. You could spread the taxation of it over 3 years. Anybody who's old enough to remember income averaging remembers that concept. But basically, by spreading it over 3 years, you were able to reduce the tax by having it taxed at lower brackets, so it doesn't pile all up into one higher bracket. Or you had the option of repaying it within 3 years so that it wouldn't be taxable at all. It was unclear whether money purchase plans qualified for that. It is now clear that they do. So that's the law made that explicit. And so that covers sort of the planning points that we wanted to touch on. So Doug, one of the things with this being an election year that we're just exiting, and there's certainly, it certainly lived up to its hype, I guess we would say, but there's always a lot of political rhetoric coming out of these types of years. Things can get pretty hot, and people's opinions about the markets and how they want to invest are often manipulated by the political activity. Do you have any thoughts about that? And secondarily, how is HCM positioning our portfolios now, and why?
Sure. So sometimes you hear, the phrases, does the narrative drive the market, or does the market drive the narrative? And I think it's probably somewhere in between. If you remember our last webinar, we talked a lot about price action and sentiment after the election. And what came out of that was a lot of optimism around the fact that everybody was excited about a divided government. So you can see these headlines here: why the prospect of a divided government sends stocks soaring, Wall Street rallies, global investors are relishing the prospect of Biden White House, Republican Senate. You may not be able to read these dates, but all of these are November 5th. So let's fast forward to January 6th, the day after the Georgia runoff. And here we are with blue wave bets revive reflation trades all over the world. So it seems like we've gone from the market loved what we had before, and then it changed its mind, and now it really loves what we have now, which is basically unilateral control of government by the Democrats. It's not a massive control, as some would say, but it's control nonetheless. So as we see that play out, we have to start to think, all right, what is the world going to look like over the next 2 years, specifically while Democrats are firmly in control? How is that going to look from a fiscal standpoint? How is that going to look from a monetary standpoint? And then how is that going to look from a market standpoint in terms of positioning? So if you recall back to our last webinar, we had a chart that showed these specific returns starting on November 3rd. And November 3rd was significant because that was the day of the election. What you saw out of that was this kind of explosion in returns of reflation asset classes. So things like value, small cap, international to a certain extent. And then we kind of charted those against the NASDAQ 100, which has kind of been the darling of the market and a lot of investors, and then just the regular broad market. So what you see here is, this is just a year-to-date chart, but I think what you'll see is the themes are very similar. And specifically the inflection point that we see, and I'm gonna try to pull up this laser pointer right here, around January 5th, which is again, the date of the runoff. So going into the year, you had these asset classes kind of clustered together with the exception of this orange line, which is international. And then all of a sudden you get this explosion in small cap return. You get this explosion in value, and you get this, explosion in international, while you have US kind of flatlining. And then actually the first day you had tech sell off a little bit. So as we see this and we think about, okay, why is the market reacting this way? It's a combination of a few things that we think have some staying power. So the idea that we're going to see easy monetary conditions going forward, and that's been something that's been present for a while. And then this idea that we're going to have unilateral stimulus across the board that's going to start to drive some of these sectors that used to be quote unquote unloved and propel them forward. Now, some people might look at this and they might look at some of the older charts and say, wow, we've come a long way. Do we still have room to run? Well, I think we do. And we're going to show that here in the next chart. So this is a chart that shows a long-term trend ratio. So as you see this black line moving down, it basically just means that the return for large cap growth is greater than the return for large cap value. So if you want to color code it based on these bars, the green shaded areas are when growth is outperforming. The white shaded areas are when value is outperforming. Now, there's a lot of information on this chart. I want to just focus on kind of this time frame around here. So what you'll see is we've just gone through the longest period of growth outperformance relative to large cap value since this data set started back in right around 1930. So it's a very long time frame. And what you'll see is over the past probably 15 years, we've seen an aggressive move higher in large cap growth over large cap value, culminating last year where we saw a few mega tech names really drive the market return. And it's come all the way up here to this inflection point right here. So when we think about this from a mean reversion, we look at this and say, wow, this has gotten to a kind of extreme level here. And you see this very tiny move on the line, and that is the beginning of what we hope to be a long value rotation that's going to start driving the value performance relative to growth downwards, meaning we're going to see higher large cap value growth. Now, this next chart, same concept. Now we're looking at small cap versus large cap. So again, a lot of information on the chart. Let's focus on the recent past here. So from about the year 2000, we'll call it 1999, you had a small cap bull market over large cap, all the way up to this point here, 2012-ish. And then since then, you've had this slow grinding outperformance of large cap versus small, culminating in, again, what we saw in 2020. Now, again, you're seeing the line reverse right here. So the last chart I showed showed the beginning of a reversion in value. And this chart is starting to show, hopefully, the beginning of a reversion in small cap. Now, one interesting thing to point out in this chart is the time frames overlap. So if you were to go and look and say, okay, what was the last time that we saw a small cap bull market? We can go down here, periods of small cap outperformance, right? So this green bar here goes from 99 to 2011. Let's go back to the chart we just looked at before. When was the last period of value outperformance? We go to the chart, 2000 to 2006. So it doesn't overlap perfectly, but what you'll see is in a lot of these time frames, when value is working, small cap is working as well, and vice versa.
Doug,
Yes.
just one thing that's probably worth pointing out is that these trends, once they start to take place, often last for a long, long time. You might draw attention to
that's a good point.
The length of these, they can run for years.
Yeah. I mean, the one that we just saw in growth, like I said, was 15 years long. And if we go to the small cap chart, again, you're seeing, decade long timeframes when this happening. But what you're seeing is small overlapping value and then large cap overlapping growth. So we've just gone through a decade long period of outperformance in growth and outperformance in large cap. So we believe that you're starting to see the seeds being sown for this cycle to start to shift. And I'll give some more reasons why we think that is. So this is one of the big reasons. Rates have a lot to do with this. So as you see this chart, we can walk through these lines. So this blue line here is something called the 5-year forward inflation expectation rate. It's a lot. So basically this is the market's implied expectation of inflation going forward. So 2%, not a lot, but you see where it's come from. Right after we came out of the COVID crash, it was under 1%. We've slowly been working our way up. Orange line is the 10-year treasury. Green line is the 10-year treasury versus the 2-year treasury spread. So basically this orange line subtracted from this purple line, which is the 2-year treasury. So the 2-year treasury rate hasn't moved at all. That is the rate that is controlled by the Federal Reserve. And they've been fairly adamant that they are not going to do anything to increase that rate in the immediate future, okay? They don't necessarily control the 10-year rate, though some would argue that they're doing their best to try. So what happens right around January 5th, again, you see this big spike up in 10-year rates, all right? It hasn't really seen the inflation yet, but the reason the bond market is starting to price in higher rates is because there's an expectation that if all this stimulus catches, you could see a significant increase in inflation going forward. Now, when this green line goes up, it's called the yield curve steepening. So just think when the spread between the 10-year and the 2-year is high, that's a steep yield curve, right? For the past 10 years, we've had an extremely flat yield curve. And in fact, we had a brief inversion 2 years ago. And an inversion just says that the 10-year rate, or I'm sorry, the 2-year rate is actually higher than the 10-year. And it's usually a precursor of recession. So now you're starting to see rates moving up. You're starting to see the yield curve get a little steeper. And normally when you get a steep yield curve, that is beneficial for value, and it's beneficial for small caps. So you think of things like financials. Financials make their money off the yield curve. They lend people, or they lend long rates and they borrow short. And as that spread widens, they make more money. And this kind of works across the value sectors. So you're starting to see, like I said, those tailwinds and the mix of all these things starting to come together. And what we're thinking is the possibility of this perfect storm of ingredients, so to speak, starting to cause these very long-term trends to turn. And we have, made portfolio moves accordingly. So going back to May, when we first started re-risk portfolios, we began to add more value-focused names in there. Just recently, towards the end of November, we reestablished a small cap position. We hold international currently, but we've looked at the possibility of increasing that allocation a little bit because of what we're seeing right here. So 2 charts on here, this one to the left, the purple line shows basically the value of the dollar. This line goes up, the dollar's doing well. This line goes down, the dollar's doing poorly. This is against other currencies. Now, what you'll notice is the orange line is the performance of international assets. So you can see that almost every time when you see significant performance in international assets, it corresponds with this purple line moving lower and vice versa. So what we've seen coming out of the COVID response is the amount of stimulus that's being thrown into the economy and the market is causing trepidation around inflation and causing people to be concerned about the dollar moving lower. So again, you're seeing a peak here in the value of the dollar, and the dollar starting to come down and down and down, getting close to the low levels that we saw at the beginning of 2018. And you've seen a subsequent recovery in international assets. And if you recall back to the chart we looked at the beginning, you actually have year to date, and really over the last 3 months, you have international assets starting to outperform the US. And again, we think this has some legs to it because of this chart right here as well. So orange bar or yellow bar or orangish yellow bar shows valuations of 3 different markets: US, developed markets, and then emerging markets. So what you'll see here is in the US, you have the highest valuation in terms of price to earning, working all the way down to emerging markets, which has the lowest valuations. Now, compare that to emerging markets who have the highest expected earnings growth per share versus the US, which has the lowest. So when we think about it in terms of time frames and kind of how we've scaled these trades, we leaned into value first, then into small cap, and then international may be the last kind of area that we look to add additional funds to. But all of these kind of are commingled into one bucket to where we think the conditions are right to start to see these assets performing well, not only versus the market, but a lot of the growth stocks that have gotten so much attention over the last 12 months. Now, I'd say that we paint a fairly bullish picture, and I think that's a fair statement, but not everything comes up roses in this situation. So this shows a chart that on the top pane has the S&P 500 composite. This goes all the way back to 2007. And then on the bottom here, this orange line, you have something called the crowd sentiment poll. So really what we're seeing is that markets probably have gotten a little bit ahead of themselves in the short term. You're seeing a tremendous amount of optimism. You're seeing a lot of short-term technical indicators that are telling you the market's overbought. You're seeing deviations that are, in some cases, historically wide. So when we look at this sentiment chart down here, what you'll notice is that these 2 horizontal dotted lines represent kind of ranges. Anything above that is deemed very optimistic, and by contrarian nature, somewhat bearish. And then the opposite down here. So the last few times we've gotten north of 70 here, here, and here, you'll notice that up here you had correction, big correction. Now, we're not saying that this is going to resolve itself tomorrow, or we're not saying that this is necessarily going to resolve itself with a 10, 15, 20% correction. You could see the market just kind of gyrate sideways for a while to work some of this off. But in our situation, we would like to see some of these extremes go away before we reallocate accounts. And we think that we've seen such a tremendous run over the past few months that we're actually taking the opportunity to take some chips off the table, not necessarily reducing risk per se, but selling off some of the excess gains that we've seen in accounts, areas that we feel like have gotten a little bit overdone. And like I said, when that situation normalizes itself a little bit, it'll open the door for us to rebalance accounts and possibly look to go into an equity overweight if conditions present itself. So I know we're right up against time here, so I want to summarize this briefly. So for stocks, the expectation for future stimulus based on the government or Democratic control should continue the rotation into value and small cap. We've already begun to allocate money to those sectors. We're probably going to look to do that continuing here over the next few weeks as opportunities present themselves. You have a weaker dollar and favorable valuations that are supporting owning international stocks. But in the short term, you have an extended market sentiment that we think will result either in a correction or in an opportunity to rebalance over the coming months or even weeks. Bonds, you have inflation expectations and rates moving higher. So bond portfolios will need to be adjusted to counter that. We're also actively working on adjusting the makeup of our fixed income portfolios right now to insulate the possibility of higher inflation and higher rates going forward. And then lastly, the themes for 2021. We think a COVID recovery and the stimulus is going to accelerate this rotation. And obviously threading the eye of the fixed income needle is going to play a large role in that. So with that, I'll pause. And Mike, did you want to add anything while I scan the questions?
Well, with regard to your last comments, I guess, the idea is that it's pretty easy to recognize an extreme situation. Doug has given you a couple of the indicators. There are plenty more. As we've said since the beginning of time, knowing it and timing it are two different things. If we had to, if we were making bets on a bar or something, I think the sort of logical outcome would be as long as we keep getting new stimulus programs, bringing in new sort of surprise money. In other words, things that the market doesn't know about yet. And tonight's speech by President-elect Biden will be one of those things. And what follows up after that, from what I understand, a very heavily concentrated stimulus program around green energy should also be very supportive of the market. But once, assuming that the vaccines work well, assuming that these new strains of the virus don't thwart that effort, once the population is pretty well vaccinated and assuming the economy is starting to run back normally, to the point where a reasonable person might look at it and say, we really don't need more stimulus, that would likely be the time that a correction would likely occur. Or that's when the conditions would be ripe, is when the market's no longer being surprised by new stimulus.
So we've got one question here, kind of regarding fixed income. How do we plan on earning money in fixed income this year? So I touched on it briefly in the summary. Really, it's going to be a balancing act between finding areas that will generate you some extra income without taking too much risk, and also not owning a ton of very interest rate sensitive debt, so to speak. So we've already started to see the 10-year Treasury move up. And for the first time in a while, you're seeing bond returns with a negative sign in front of them, through the first 2 weeks of the year. So our strategy is, looking at other avenues. We've looked at the possibility of adding some inflation sensitive fixed income assets. We've looked at adding some managers who are able to work in a larger toolkit, can access markets, globally, as well as, maybe some niche areas that can kind of thread that needle between generating some additional income without generating too much excess credit risk. So it's certainly going to be a challenge this year. I think the most important thing to remember in that is that, bonds are there to be kind of a counterweight to the equity risk of portfolios. And even with the expectation that, fixed income could be challenging going forward, you certainly don't want to completely upend your bond allocation and add too much risk to that and kind of take away one of the key tenets of owning fixed income in the first place. Mike, do you have anything to add to that?
Yeah, I guess just in terms of a frame of reference or way to think about it, interest rates have been falling since Reagan and Volcker were in the White House. I mean, if you remember, prime rates went to 20% in an effort to break the back of inflation, and rates have been declining ever since. And so bonds have been providing, returns above expectation. In effect, we have borrowed returns, and now that the government has artificially depressed interest rates, we've borrowed returns from the future. So it's not like that the bonds aren't making the money, but the question it makes an excellent point, and one that we talk about a lot in the investment committee. it's going to be a very difficult year. So you're mixing asset classes in order to of fixed income asset classes. You're dealing with credit. That tends to be where the yield is, as Doug said, duration or longer term. That's where you're going to get burned. We're looking at inflation protected securities that would benefit if inflation does spark a little bit early. But it's this, 20 years ago, bonds were easy. Today, bonds are hard.
Mike, did you want to touch on the coat drive?
Yeah, just briefly. This is something we're asking for everybody's help on. HCM, we try and be in the community and doing things to help people. Our current effort right now is we are working with St. Vincent de Paul to collect coats, new or gently used, hats, mittens, gloves, anything, any sort of cold weather wear would be much appreciated. We have 2 barrels in our Western Hills office, one on the first floor and one on the second floor. So it's a touchless contribution. If you want to clean out some closets and you have some coats or some other winter wear that you want to get rid of, please bring them over. If you can't get here, give us a call. We'll arrange to get it picked up. Again, it's things you're not using, and it's going to go to a great cause. We've been pretty lucky so far with winter, but we know it's coming. And if we can help people, it's a great thing to do. And so that does it for today's effort. Thanks everybody for participating. As always, if you have any questions in between our calls, feel free to reach out to your advisor. If news breaks, we will schedule a call to give you our perspective. And if news doesn't break, we are tentatively scheduled for, I believe, it's a Thursday, February 11th. So if you want to circle your calendar, that's a tentative, but we're pretty good about hitting those dates. And I think that does it. So again, if you need any help, give a holler. If you know anybody that needs some help, we'd be happy to do that. Otherwise, until next time, that does it. Thanks, everybody.